Right now you have some amount of money, maybe in your pocket, maybe in a bank account, maybe in both. You earned that money by doing something, working, selling, creating. Someone gave it to you in exchange for your time or your effort or your skill. And tomorrow you will probably spend some of it on food, on rent, on something you want. And the cycle continues. But here's the thing. Almost nobody actually understands what money is. Not really. Not where it comes from. Not who controls it. Not why it has value. Not what actually happens to it when you put it in a bank. Schools teach you how to count it, how to budget it, maybe how to save it, but they almost never teach you what it actually is. And that gap in knowledge is not an accident. But we will get to that. Let us start at the very beginning. Because money is one of the oldest inventions in human history. And understanding where it came from tells you everything about what it actually is. For most of human history, there was no money at all. People traded directly. You have grain, I have fish. We swap. This is called barter. And it worked fine for small communities where everyone knew each other and everyone produced roughly the same things. But barter has one massive problem. What if I have fish and I want grain? But the grain farmer does not want fish. He wants wood, and the woodcutter wants shoes, and the shoemaker wants fish. Suddenly, every simple transaction becomes an enormous logistical puzzle. You need to find someone who has what you want and wants what you have at exactly the same time. Economists call this the double coincidence of wants. And it is why barter systems always collapse as communities grow larger. So humans invented a workaround. They found objects that everyone agreed to accept as a middleman in any trade. Shells, beads, salt, cattle. At different times in different places, all of these things have been used as money. What made them work as money was not what they were. It was that everyone agreed they had value. This is the most important thing about money that most people never fully grasp. Money is not valuable because of what it is. Money is valuable because of what everyone agrees it is worth. Money is a shared story, a collective belief system. It works because we all agree it works. If everyone on Earth suddenly stopped believing in money tomorrow, it would instantly become worthless. A $100 bill is just a piece of paper with ink on it. The only thing that makes it worth $100 is that the person you hand it to believes it is worth $100. Eventually, humans settled on gold and silver as the most popular forms of money. Because they were rare, they did not decay, and they were easy to divide into smaller amounts. For thousands of years, gold was money. Empires rose and fell on how much gold they controlled. But gold has a problem too. It is heavy, it is inconvenient, and carrying large amounts of it around is both difficult and dangerous. So merchants began depositing their gold with goldsmiths who had secure vaults. And the goldsmiths gave them paper receipts in return. These receipts could be traded instead of the gold itself, because everyone knew the receipt could be exchanged for real gold whenever needed. This was the birth of paper money. But then the goldsmiths noticed something very interesting. Almost nobody ever came to collect all their gold at the same time. People were happy to keep trading the paper receipts. The gold just sat in the vault doing nothing. So the goldsmiths started doing something that would change the entire world forever. They started issuing more receipts than they had gold to back them. If they had gold worth $1,000, they might issue receipts worth $2,000, lending the extra receipts to people who needed them and charging interest. As long as not everyone came to collect their gold at the same time, nobody would ever find out. This is called fractional reserve banking, and it is still how almost every bank in the world operates today. When you deposit money in a bank, the bank does not just store it in a vault waiting for you. The bank keeps a small percentage in reserve, usually around 10%, and lends the rest out to other people. And here's where it gets really strange. Because when the bank lends that money out, the borrower deposits it in another bank, and that bank keeps 10% and lends the other 90% out again. This chain can repeat many times, which means $100 deposited in a bank can eventually result in $900 or more of loans existing in the system. Banks do not just store money. They create it. Most of the money that exists in the world today was not printed by a government. It was created by commercial banks making loans. This sounds insane, but it is exactly how this system works. And it has enormous consequences for everything else in your life. Because if banks are creating money by making loans, then money and debt are two sides of the same coin. Every dollar that exists in the system exists because somewhere someone took out a loan. And every time a loan is repaid, that money is destroyed. This means the entire money supply depends on people continuing to borrow. If everyone paid off all their debts tomorrow, there would be almost no money left in the system at all. Now here is where the government comes in, because somebody needs to oversee all of this, to decide how much money exists, how fast it grows, and what it costs to borrow. Most countries have a central bank. In America, it is called the Federal Reserve. In Europe, the European Central Bank. In the UK, the Bank of England. Central banks do not work for you. They are not government departments. They are technically independent institutions whose job is to manage the money supply and keep the economy stable. They do this primarily by setting interest rates. When interest rates are low, borrowing is cheap. People and businesses take out more loans. More money flows into the economy. Everything grows. When interest rates are high, borrowing is expensive. People take out fewer loans. Less money flows. Growth slows down. Central banks raise interest rates to slow inflation and lower them to stimulate growth. That is their primary tool for controlling the economy. But what is inflation? Because most people think they understand it, and most people are wrong. Most people think inflation means prices go up. And that is true. But why do prices go up? The simple answer is that when there is more money chasing the same amount of goods, each unit of money buys less. Imagine there are 10 apples in the world and $10 in the world. Each apple costs $1. Now imagine someone prints 10 more dollars. There are still only 10 apples. But now there are $20. So each apple costs $2. The apples did not change. The money changed. Inflation is not prices going up. Inflation is money losing its purchasing power. This is why your grandparents could buy a house for what seems like nothing today. The house did not get more expensive. The money got less powerful. And here is the uncomfortable truth about inflation that nobody really talks about. Inflation benefits people who own things and hurts people who hold cash. If you own a house and inflation rises, your house becomes worth more in dollar terms, even if nothing about the house changed. But if you have $10,000 in a savings account and inflation is running at 3% every year, you are losing $300 of purchasing power every single year, even if the number on your account never changes. Cash does not just sit there safely. It slowly loses value. Every single day. This is why rich people almost never hold large amounts of cash. They hold assets, real estate, businesses, stocks, because assets tend to go up in value as inflation rises, and cash tends to go down. This is one of the biggest reasons why the gap between wealthy people and everyone else keeps growing. It is not just that rich people earn more. It is that the system itself is structured to reward people who own things and quietly penalize people who only hold cash. Now there is one more layer to this that almost nobody understands. And it is the strangest part of all. Remember how banks create money by making loans. And remember how the borrower has to pay back more than they borrowed because of interest. When you borrow $100 from a bank and agree to pay back $110, where does the extra $10 come from? The bank created the original $100 by making the loan, but did not create the extra $10 needed to pay the interest. That extra money has to come from somewhere else in the economy, from someone else's loan, from someone else's labor, from someone else's savings. This means the total amount of debt in the system always grows faster than the total amount of money in the system. There is always more debt than money to repay it, which means the system mathematically requires constant growth to function. Constant new loans, constant new money creation, constant expansion. When growth stops, the system starts to break down. Loans cannot be repaid. Banks fail. People lose jobs. Governments step in, and the cycle resets. This is what happened in 2008, and in 1929, and in dozens of financial crises throughout history. The same pattern every time. So what does all of this mean for you? Right now, in your actual life, it means that keeping your money in cash long-term is quietly losing you money every year through inflation. It means that debt is not just something you owe. It is literally how most money is created. Understanding debt means understanding money itself. It means that the people who understand these systems and own assets within them tend to build wealth. And the people who do not tend to work harder and harder just to stay in the same place. None of this is your fault. You were never taught it. Most people are never taught it. And the people who benefit most from you not understanding it have very little interest in changing that. But now you know. Money is a shared belief. Banks create most of it through loans. Inflation slowly erodes cash. Assets grow with inflation, and the system requires constant expansion to survive. Understanding these things does not make you rich overnight, but it changes how you see every financial decision you will make for the rest of your life. And that is worth more than any amount of money in a savings account slowly losing its value while you sleep.